welcome to the Monday Futures Market Outlook for July 30th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the U.S. dollar index futures, and we want to take a look at that primary uptrend that we've been seeing in the U.S. dollar throughout the year. We in the last week had a material reversal on the downside, and it came quite distinctly right across the board and almost all cross currencies. The Aussie and the Canadian dollar had some resounding strength. Even the British pound had a strong reversal, but the largest impact obviously was the 300 to 400 pip move in the euro that basically was spurred on, which we'll talk about in just a moment. This created definitely some short-term selling on the dollar, but recognizing that the primary uptrend is not in any way violated, and we still will be looking to see where the short-term lows come in on the dollar index. It would be material if we saw a break below the 81.50 to 82 level support line down below, but so long as all the selling is contained, we'll remain bigger picture bullish the U.S. dollar still, but nonetheless the short-term upside breakout that we were looking for last week simply hasn't followed through, which diminishes the probability that this week we'll see any material upside unless it was driven by obviously a disappointment in Draghi's policies on the euro, or in fact the jobs numbers that come out on Friday in the U.S. When we take a look at that euro, you can see that euro bounce that came off that 120 level right back up to where the lows occurred back in May along that downside. This 124, 125 level should behave like an overhead resistance level where all the retracement zones lay. It would be a material event if the euro was able to muster up a rally above the 124, 125 level. Even a temporary break above 124 and then return back down below would be just noise. But if the euro was destined to retest 127, 128, or even head for a full retracement back to 129, 130 on the upside, that would have a material effect on the intermarket relationships. And therefore, what we're really going to be watching over the next week or two is whether or not this bounce was simply an oversold bounce from a downside target, or whether or not we're going to see something much bigger picture develop here. While at this stage the primary trend of the euro is very distinctly lower, and at this point these rallies have been nothing more than just an oversold bounce. But we're going to be watching if that develops into something more over the upcoming week. Next year I want to talk about the 30-year U.S. Treasury bond, and the U.S. Treasury bond was attempting to break to new highs, and basically had a material reversal on Friday based upon the momentum that was coming in so many of these cross markets. This selling in the bonds is definitely reactionary, but as well, and it's far too early to suggest that this is a change in trend. But nonetheless, it is enough of a material price action change that the most immediate upside targets have been nullified. At this stage, we're going to want to see where and how the Treasury bonds bang out a short-term low, or how far they go down before they do even consider putting in a short-term low. We could see a testing of all the support lines that came in the month of June, all along the 148 level, or even a test of the swing low around the 146, 147 low. Nonetheless, we're going to be watching the follow-through. In order for us to be bearish the stock market, we wouldn't need to see a strong bond market. So weakness in the bond market is certainly one of the key components that allowed the S&P to make the move that it did, and the way that the bonds behave here this week will have a material impact on whether or not the stock markets remain in short-term trend. Next year I want to talk about copper futures, and copper, like actually all the commodities we're going to talk about, has actually not participated in this last little bit. Traditionally, a material move like this on the US dollar and euro would certainly allow many of the effects to come into the commodity prices, and would have seen some surprising strength, but we haven't seen that yet. In fact, the wedge that we've been looking over the last month to develop on copper has actually actually not technically been violated. This is the first interesting observation that we have about the sustainability trend. If we really saw a material breakdown in the US dollar and subsequently a material reversal in the euro and other currencies, then we would already be seeing a lot of these commodities start showing some sort of strength. And the fact that we haven't seen that yet is just a thing that immediately puts our attention here to see whether or not it's simply lagging behind, or whether or not it's a signal that this US dollar sell-off can't be trusted, and that in fact the US dollar will likely come back up. Nonetheless, weakness in the copper here, so long as copper continues to fail down at these levels, as soon as all the markets revert back to their original trends, we would still be looking for a breakdown in copper to come all the way down towards the $3 level on the downside in the big picture. But understand that this is likely not to occur in an environment where the stock market's strong, bonds are weak, and the US dollar is correcting. So it may not be necessarily imminent that copper is breaking down here, but we'll be watching this pattern develop. Next year I want to take a look at crude oil, and crude oil has a similar pattern as copper, in the sense that we were looking for overhead resistance in this 92 to 97 kind of area to contain the upside of crude oil and what was this rising wedge. But even in spite of the resounding strength that we saw over the last couple trading sessions, the crude oil simply has not participated, no different than copper. And this is interesting because we're seeing this on a lot of different markets. Nonetheless, we are still looking to see whether or not crude oil bangs out its tops here. If we still see that the trend continue for another week, we could see crude oil return back to 93, 94 on the upside. But we, again, in the bigger picture, remain skeptical that these commodities will be able to have any resounding strength here. In fact, we think that once the currencies and the markets have finished playing this little retracement squeeze game that they're doing right now, that in the next reversal of into the main trend, these commodities will likely be selling. Next year I want to take a look at gold futures, and gold mustered up a nice little rally all the way back up to the overhead resistance around the 1630, 1650. And while it is a break of that sort of declining trend line there, that doesn't negate the importance of these overhead resistance levels. A lot of times what we see as sort of these horizontal triangles is nothing more than a sideways range bound market that simply rejects on overhead resistance. So we're coming to a crucial decision point here on gold, because if the bulls can't muster up a push to new highs, then it will simply roll over and reject at this level and trade right back to the bottom end of the range. So let's watch to see whether or not the bulls can beat this area. I think that there's plenty of time to go bullish gold once we've seen a reversal in the primary trend. So let's first let gold make the break higher and then look for pullbacks to trade it if it is going to turn bullish. Next, that brings me to want to talk about the weekly charts of the S&P 500. And as always, we plot an 80-week moving average on there to depict the bull and bear market cycles the market has gone through. You can see we bullishly crossed above that 80-week moving average last year, and the market has stayed above that 80-week moving average actually since then. Even this the sell-off we saw back here in May has yet to violate that with any sustainable push lower. This basically is one of the reasons why we remain long-term neutral, the equity markets, rather than bearish the way we are on the global equity markets, because we simply haven't seen any follow-through weakness in this area. While we do believe there is still room for the markets to correct into the fall, we would need to see a material breakdown of the prices below 1300 for us to in the big picture become bearish. So when we take a look at that S&P 500 on the daily charts, we've been looking for a rising wedge that was likely to fail in this 1375 kind of area on the upside. We had nice little double tops going, but we did suggest that we needed a break to lower lows below 1320 in order for us to confirm a break. And really at this stage, when we went and traded down there and found that support line, the moment the market was given a stimulus. In this case, it was Draghi's comments out in the euro zone that spurred on a massive short squeeze that now has actually had the market break to a higher high. This essentially neutralizes the most immediate bearishness that we had in this market, and what will now at this point leave us looking for some price action this week to see how things react. The biggest variables are, again, when Draghi later this week speaks in regards to what plans they had in order to stimulate the eurozone, as well as the jobs numbers that will be coming out on Friday, will all give some substantial information in terms of how everything is positioned. If everything later this week ends up resulting in disappointment, and the markets, let's say, revert all the way back down to 1340 or 1320 over the disappointment of that news, then that would actually be very bearish. But in the same regard, so long as the bulls at this point can keep things relatively neutral, that we now have to actually consider the possibility that we have to go and retest the highs at 1400 to 1420. At this point, we're very neutral in terms of what is likely to happen, as the direct bias that we had bearish this market has been negated. At this stage, we're going to look for price action to develop here. The only thing that would have us revert back to being distinctly bearish this market again would be a material breakdown in the euro at the same time as the S&P 500 not holding this breakout and getting back down towards, let's say, the bottom end of that range where it traded around 1340 and 1320. Until we see that, we're going to remain relatively neutral and open to the idea at this point that the market may double top retest at 1400, 1420. Just to make our key intermarket observations, we at this point had changed our short-term stance to neutral the U.S. dollar, as that reversal in the euro has neutralized the most immediate benefit that we were getting in terms of the stimulus. The only market that is still distinctly bearish or hasn't violated the bearish trend has commodities. So we're going to remain short-term bearish those commodities, but the reversal candle on the bonds, as well as in the stock markets, both on the U.S. market and the global markets, has us at least be neutral. The reason we haven't reverted to short-term bullish on any of those versus neutral is really the fact that even though we don't see the immediate move occurring now, we also see only marginal benefit in the upside of any of these moves. And so really at this stage, because the risk-reward proposition is so poor at this level, and we don't want to change that short-term stance to implying that we think that there's an opportunity to capitalize in that trend. So nonetheless, very neutral. We're going to obviously spend the early part of this week waiting to see how the markets absorb all the information later this week, and then we'll develop some biases going into next. That was your Monday Futures Market Outlook. Thank you for joining me.